alone. A lot of our investors, as we went out and started building our multifamily portfolio through Lucerne, and my partner Frank is here, we were able to translate those investors over. We built that rapport with them. But at the same time, everything comes down to track record. It's easy to sell them on the deal day one, potentially, if you're a good salesperson, but you have to deliver, and if there are problems, you need to be upfront. We've had challenges in deals, and we talk to our investors, explain what we're doing, and we treat their money as if it was mine or my parents' or my brother's money. And that gets translated to them, and they appreciate it. And people want to invest with people that they trust and think will be a good steward of their money. So I don't know how I wound up here. It's an amazing, like, sometimes I say to myself, wow, and I built a great team and have incredible partners, but we've been able to consistently provide returns for our investors. And the last thing I guess you say on the script is really, it's not a script. You have to find an asset that you're comfortable with and you can speak to in every detail about how you're going to provide that return for your investor and what risks are involved, and be honest about it. Try to talk them out of the deal. Try to tell them all the big problems that can come up, and they really appreciate that, and you build that trust. So that's kind of my story.
Thank you.
I started off as a buy and hold investor. So I purchased my first home in 2007, and it was a luxury condo in Jersey City. I got onto the board of directors of that building, and as the real estate market was kind of cooling down and the building was almost sold, they only had last 3 or 4 condos to sell, and they shut down their sales office, and I knew that they might be willing to give us a very good deal. So I asked my uncle if he would want to partner with me and kind of buy one of the last 4 or 5 condos, and he agreed, and we got a great deal on that one. So that was my first entry into real estate investing as such. Taught me a lot of good things, tenant management and stuff like that. And then I just started educating myself, reading up on BiggerPockets and other websites how to, and then I got into small multifamilies, did that for a while. Then I went on to foreclosure investing. So started buying up Hudson County foreclosures, a market that I was really familiar with. And that was, I didn't have money, when I was doing that. And so in between, I also started my realtor business. And what I would do is I would help, landlords rent out their rental units. And in that meantime, I built very good relationships with a lot of wealthy investors who were landlords. And they were kind of making very minuscule returns on their property, because these luxury condos, they don't cash flow very well, so they were making probably 2 or 3% cash on cash returns. And then foreclosure investing came up, and I didn't have the money, so I asked them if they would be willing to lend money on that, and a lot of them came on board. So that was my real first time raising private money. And as things progressed, I went on to large multifamily, invested. Actually, first I invested with in a few deals in North Carolina and Texas, and then went on to raise money for some partners. So as David was talking about, people don't people have to trust you. So I had built the trust when I was serving them in the realtor relationship. They knew how I executed and stuff like that, and my process was flawless, and I could deliver on what I said. Like if I told them I could get a particular rent for their property, I was able to get them tenants and stuff like that. When they came in investing with me on foreclosures, I told them about all of the risks, and I told them about the returns that they can expect, and I delivered on them. And as with that, I was able to grow my network and then finally do bigger deals.
Excellent. Thank you.
So it kind of feels like everything I did in my life led up to this. And I take most of my career has been in the sales field. So that's kind of the approach I take to it. However, I actually initially, a year or so out of college, decided I want to get into sales. And I kind of took a Robert Kiyosaki, Rich Dad Poor Dad approach where what's the hardest thing I could do? So I was like, let me sell insurance. Got my Series 6, 63, life and health, and making 100 plus phone calls a day to little old ladies who told me to screw off. So I really was, and young and dumb, I just kept calling. I was actually enjoying it because I knew that I had an opportunity to help people grow their wealth, and that's what I essentially got into it. And I think it's Zig Ziglar, the quote that I've found out later, but I'm like, oh, this describes it pretty well. If you help enough people get what they want, you'll end up getting what you want. So that's kind of, now I have a quote to put to it, but I was living that life trying to do that and figured I know a lot of people that made some good living doing this route. And so let me try and help a lot of people grow their wealth and feel good about what I'm doing. So a year later, I'm prospecting a commercial real estate broker on the golf course. And I was like, hey, I think you need to diversify some of your retirement accounts. He goes, I think you need to get your real estate license. So got licensed 11 years ago. If you want to do the math, that's August 2008. It sucked. We had a $140 million deal, 18 garden-style apartment complexes, portfolio sale, and the following month, Lehman Brothers went bankrupt, and I moved back in with my parents. So a couple years of struggling, then I decided, you know what, I'm living in Hoboken, where I was living in Hoboken, sorry. People are still paying a good amount for condos and rentals, so ended up doing that for a little bit, and then I got into ad sales while the market was still horrible, and got back into real estate full-time 6 years ago. So I was actually starting to get taught better sales training with the company I was with, and really learned how to kind of regrew the passion for the real estate. And then I was starting to make enough money to invest myself. Bought a 2-family in Hudson County, and from everything I've learned and the people I've been surrounded by, fortunately, part of the success has also been going after and searching out people better than me. I want to be the dumbest person in the room at all times. I want to make sure that I'm always growing, always pushing myself. So I really learned a lot quickly in the past 5 or 6 years, and randomly enough, got connected with Jason's wife on a referral deal. She's like, oh, my husband's looking to invest in the Jersey City area and whatnot. So I was like, great, let's do it. And then after meeting him a couple times, he goes, oh, my high school buddy Kevin. We're investing out of state. I finally meet Kevin. I've already known you for like 6 years. He was a part-time broker at the former Hoboken brokerage I was at. So we already knew each other. So it was instant rapport, and knew that I was surrounded by some quality people. So when I didn't get the chance to raise on their first deal, but we did 3 more since. So in the past year, acquired 364 units. And my approach, like I said, is very sales oriented. So always looking to see what people might need. And I found out, especially real estate professionals, which the IRS calls us people that work in real estate at least 750 hours a year, breaks down to about 15 hours a week, and it has to be a certain percentage of your income, et cetera. But let's just say a full-time realtor. We have a big tax issues, being 1099 employees, and I kind of found that whether they weren't impressed with 8 to 10% returns, or they weren't opening their eyes, they probably just weren't listening altogether. I came to flip the script, and I was like, oh man, I can't believe how little I paid in taxes this year. And they're like, what? What are you doing? What are you talking about? I'm like, oh, that 8 to 10% cash flow year? Yeah. It's called depreciation in the 2017 tax reform. It helps us extremely. So let's sit down, grab a coffee, and talk about this. So I've actually been doing a tour, going around a lot of real estate offices, talking to brokers all over the tri-state, talking to them about this. And even other very successful people. I caddied at a country club for 15 years. These are guys that made tons of money. They've done it. Some of them have done it in real estate, doing it themselves, which can be a slow process, especially smaller properties, single family, 2 to 4 family, a lot harder to scale. You need to make a lot of your own money. So this is a more scalable way, and especially if you're aging out, everyone likes passive income. I love getting paid for doing nothing. But so I've always asked, taking the approach of what are they looking for in their life and kind of gear my script or talking towards that. But for most people, it's taxes. So.
Cool. Keeping like that, can you talk a little bit about some of the attributes specific to multifamily that investors or potential investors are looking for? Talk a little bit about cash-on-cash return expectations, IRR expectations, preferred return expectations, holding periods, those kinds of things.
Sure. So I find it's not actually terribly common that the people are so educated on it. I always feel like I'm training them up or educating them on what we're offering and what syndication process can do for you. So, and then that causes a problem too, because I had someone say, hey, can you raise $12 million on this New York City office development? And I was like, yeah, my people are looking for like 8% preferred returns, 15+% IRRs, and 2x equity multiple over 5 years. Because those are the things I talk about with the average deal I come across. So if pretty much I'll put my hand out there, but don't expect much from me. So yeah, past couple of years, you can get at least 8% cash flow a year. Oh, my 401k did better than that. Well, I like to talk to them at the end of this year. Especially, I work out of Hoboken, live in Bergen County, surrounded by, and even this area too, Wall Streeters, etc. People heavy in equities, which can make really good money, however, huge taxable event. So the typical deal that I like to get behind is usually offering 8%, 7 or 8% preferred return, which means the investors get paid first before a general partner sees a dime on the annual cash flow. And not to say that can't exceed it, and hopefully most of the deals do exceed that percentage, so they're making more. However, the added benefit is like I said, the tax benefit through depreciation. We're able to do 100% bonus depreciation. So year one, I've heard of a lot of past investors averaging almost 70% of what they invest as having a write-off of 70%. So people that put in $100,000 got a $70,000 write-off that year. Obviously, every project varies, but that's some solid numbers that some people I've spoken to have been getting. And so that's huge. You had cash flow in your pocket. You're making money, but you're able to tell your accountant, no, I didn't make that much money. In fact, give me back some more. So that helps explain the tax benefit. But 8% is usually the preferred return. Most people are kind of expecting or looking for, hoping for, and hopefully it exceeds that. Internal rate of return, this is when you're talking to someone that knows their stuff. Usually looking for 15% and above, which is pretty good on their money. And hold period, usually seen about 5 to 10 years, 5 to 7, a little more common. A lot of people underwriting for more than 5 years at the moment, just to make sure that if a market correction comes and suddenly the world falls apart, that we're not left, it's 4.5 years, got to get ready to sell this place at the bottom of the market. So, and overall, the equity multiple. So the money that you invest, the total return you get. So if it's a 2x, that means you literally doubled your money. You put in $100,000, and between your quarterly returns and the chunk of equity you get at the sale, that totaled 2 times your money. So a lot of people looking for 2x on that. Some people underwriting and projecting over 2%. I've seen a lot of 1.7, 1.8, which maybe there's a small chance you could get your money working harder for you somewhere else, but still not bad. Still probably outpacing the S&P for sure. So.
Good, thank you.
So what I've seen is, two kinds of investment returns. Like, there is one camp that is splitting every dollar that comes into an 80-20 bucket. Like, investors keep 80% and so sponsors take 20%. And then there is another camp where They are generally, and in the first camp, there is no preferred return being given out. In the second camp, there is like a preferred return of 7 or 8%, as Dan mentioned, and then everything else is split 70-30%, 70 and 30. So yeah, pretty much like 8% cash on cash, 70-30 split, and 2x equity multiple over 5 years. That's what we strive for, 15 to 18% IRR. I think that's.
And David, do you want to talk maybe about holding periods and some other?
Sure. Do you mind if I touch on that too?
Yeah.
Sure. I'll stand again. So I like to use the Outback Steakhouse slogan, no rules, just right. I think that when you're going out to raise capital, every deal's its own fingerprint, and there are some general understanding of where they were talking about a preferred return. In the deals that we've done historically, we've had a 6 pref and a split on equity after, but we're in a different environment now, and the market is, interest rates have come down, and I think the important thing is that when you're talking with an investor, you have to get them